Here's something that sounds crazy but is true. Over 85% of professional investors fail to beat a simple index fund. These are people with MBAs, PhDs, and entire research teams. Meanwhile, beginners quietly outperform them by doing almost nothing. In this video, I'll break down what index funds are, how they work, and how you can use them to build long-term wealth. Without stress, hype, or guessing, let's keep this simple. What is an index fund? Let's start with the basics. You've probably heard of the S&P 500. That's just a list, an index, of the 500 biggest companies in America. Apple, Microsoft, Nvidia, Google, you name it. Now here's the genius part. An index fund is a fund that buys all the companies in that index, not some of them. Not the ones a manager thinks will win. It buys everything. If the index has 500 companies, the fund holds all 500. If the index has 4,000 companies, it holds all 4,000. There's no predicting, no stock picking, and no genius manager trying to outsmart the market. The fund simply mirrors the index and holds it. When the index changes, a company gets added or removed. The fund adjusts automatically. That's it. Simple, clean, and no drama. Imagine going to the horse track and instead of trying to pick one horse, you bet on every single horse. No matter who wins, you win. That's what an index fund does. Index funds were invented in 1975 by John Bogle, founder of Vanguard. For decades, people laughed at them. Today, they're the #1 way Americans invest. Let's look at how index funds work. With actively managed funds, there's a whole team researching companies, making predictions, buying and selling stocks, and trying to beat the market. Every decision costs money: trading fees, taxes, salaries, and research costs. With an index fund, there's basically a computer program that automatically tracks the index. They operate on a rules-based system with minimal human decision-making. When Apple's stock goes up, the fund owns it. When a company drops out of the S&P 500, the fund sells it. Otherwise, it just sits there. The fund barely trades. It just tracks the index. And because the fund doesn't do much, the cost is almost nothing. Some index funds charge as little as 0.03% or 0.04% per year. On a $10,000 investment, that's literally like $3 or $4 a year. Compare that to active funds charging 1% to 2% every year. On that same $10,000, you're paying $100 to $200 annually. It sounds small, but over decades, those costs explode. Let's dive deeper into index funds versus active funds. Now here's where things get eye-opening. Let me use a simple illustration. Let's say the market returns about 10% a year. I'm using 10% for the illustration because the average stock market return is 10% annually in the US, while the actual return may vary widely from year to year and closer to 6 to 7% when adjusted for inflation. Now, if you invest $10,000 in a low-cost index fund and leave it for 25 years, you end up with around $108,000. If you invest that same $10,000 in an actively managed fund, with typical fees, trading costs, and taxes, your money grows to only around $68,000. These are hypothetical examples for illustration, and past performance doesn't guarantee future results. But the principle is clear. That's a $40,000 difference, gone. And you didn't lose it in the market. You paid it out in fees. And here's the worst part. You're paying those higher fees for worse performance. Because after all the costs, most active funds don't even match the market, let alone beat it. Dividends? Same story. Historically, dividends make up around 40% of long-term market returns. Both fund types pay out dividends, but active funds erode returns through higher fees, excessive trading costs, and tax inefficiency from turnover. So you're paying more to get less. It's like ordering a large pizza and receiving a medium, but still paying full price. Why index funds win? Now you might be thinking, okay, I get it. Most managers lose. But what about the good ones? What about the fund managers who beat the market? Here's the truth. Even the best fund managers rarely win long-term. Over 10, 15, or 20 years, about 85% to 90% of professionals fail to beat the index. These aren't casual investors. These are experts with unlimited resources, and they still fall short. And here's something most people don't realize. Those numbers actually look better than reality. Why? Because failed funds disappear from the record. When a fund does so poorly, it shuts down or gets merged away. It vanishes from the statistics. We only see the survivors. So when you hear 85 to 90% underperform, that's only counting the funds that survived long enough to be measured. The reality is even worse. So why do so many funds fail in the first place? Because of simple math, what John Bogle called the relentless rules of humble arithmetic. Before costs, the stock market is a zero-sum game. For every manager who beats the market, another must underperform by the same amount. But after fees, trading, and taxes, it becomes a negative-sum game. As a group, active investors must underperform the market. They're paying too much to play the game. Even legendary investors know this. Peter Lynch, who ran Fidelity's legendary Magellan Fund and crushed the market for years, said the average person would be better off in an index fund. Warren Buffett, one of the greatest investors of all time, instructed that 90% of the money he leaves to his wife should be invested in a low-cost S&P 500 index fund after he's gone. When the people who actually beat the market tell you to just buy index funds, maybe you should listen. The behavioral trap. Now we get to the real reason many investors lose money. Behavior. Here's a brutal truth. The average investor earns less than the actual fund they're invested in. Why? Because people buy high and sell low. We've all felt that fear before, watching our investments drop and wanting to pull out. A fund does well. It's up 40%, and everyone rushes in at the top. Then the fund drops, people panic, and they pull out at the bottom. Then they jump into whatever is hot now. And the cycle repeats. During the tech bubble, investors put just $18 billion into stock funds when markets were cheap in 1990. But when stocks peaked in 1999 to 2000, they poured in $420 billion. Then after the crash, when stocks were cheap again in 2002, they poured in just $36 billion. Buy high, sell low. Human emotion destroys returns. Index funds protect you from yourself. There's nothing flashy to chase, nothing to predict. You buy the market and hold it through everything. Good years, bad years, recessions, bubbles, fear, and excitement. And yes, your balance will drop during downturns, sometimes significantly. That's normal market volatility. But that consistency through the ups and downs is where the real magic happens. How to actually start. So if you want to start with index funds, here's the simplest way. Before you invest a single dollar, make sure you have an emergency fund covering 3 to 6 months of expenses. That foundation is critical. Once that's in place, choose your fund. For most beginners, you only need one of two options: an S&P 500 index fund or a total stock market index fund. The S&P 500 gives you the 500 biggest US companies. The total market fund gives you almost every publicly traded company, around 4,000 stocks. Both are excellent. Don't overthink it. Next, check the fee, the expense ratio. Make sure it's low, under 0.1%. Many are 0.03% to 0.04%. Then choose your platform. Vanguard, Fidelity, and Schwab all offer great low-cost index funds. And here's a quick tip. If you have access to a 401k or IRA, invest through those tax-advantaged accounts first. You'll keep more of your returns by avoiding or deferring taxes. Finally, invest consistently. Automate it if you can, monthly or every paycheck. Don't obsess over timing. Don't panic during downturns, and don't get greedy during uptrends. Just add money consistently and let time handle the rest. and avoid complicated or enhanced index funds that promise to beat the market. Index funds aren't flashy, they don't have hype, and they don't offer drama, but boring wins. Wealth isn't built through excitement, it's built through simple, consistent habits. Keep your costs low, stay invested, let compounding work, and allow time to do its job. So if you're just starting out, don't overcomplicate it. One low-cost index fund, consistent contributions, and long-term patience. That's the formula. And if this video just saved you thousands in future fees, hit the subscribe button for more simple financial lessons that work.